Thank you so much for joining. In our last video, I did an introduction to credit risk. Today, I want to talk about the components of credit risk and more specifically how to measure credit risk. When we talk about fixed income investors or debt investors, they face credit risk. What it means, they face risk that the issuer, we say issuer because either a company or a government, they issue debt. And they have a risk that those issuers, these are actually also the borrowers, cannot make their promised interest and principal payment. So if they raise debt or if they go to the bank and ask for a loan, they are the one who borrow money. On the other hand, if it's a debt instrument, they issue a bond to the investor. If you go to a bank, you ask for a loan. And the risk here, the credit risk, is that the borrower who has raised money cannot pay the money back or cannot pay interest payments. And there are a few terms we are talking about. The first term is called expected exposure, and this is basically the total size. So if you raise, I will do an example in a bit, but the expected exposure is the total of amount of what you have borrowed. So this is the exposure. The higher the amount, the higher your exposure. Then if the borrower becomes default, then is there a chance to recover a certain amount. So if you have an exposure of $100 and you believe you can recover $40, then your recovery rate is 40%, because you think if something happens, I can still recover 40. So my loss severity is 60. I cannot recover 60 and I will lose it. Then we talk about loss given default, which is basically your expected exposure times 1 minus your recovery rate. So assume the amount that was borrowed from you was 100, and you want to understand the credit risk that you have, then your expected exposure would be 100. And if you think the borrower could become default, in case of default, your recovery rate is 40%, which would mean 100 times 1 minus 40% is 100 times 60%, which means $60. So your loss, in case there is a default, loss given default, the investor's loss conditional on an issuer event of default would be 60. And then the second term is your POD, probability of default. And then in the end, the probability, how likely is it that the borrower becomes default? And then what is my loss if default happens? And then the overall, we call it expected loss. And expected loss is basically the probability weighted shortfall if the issuer cannot make principal and interest payments. So let's take an example. Let's look at an example. The terms may sound a bit complicated, but it's actually quite simple. Let's suppose you go to a bank and the bank lends you $100,000 to a borrower. You are the borrower. So then the expected exposure, bank lends you 100,000. So the expected exposure is 100,000. Yeah, because the bank has lent you 100, you have borrowed 100. And then we assume recovery rate, let's assume 40%. So the bank expects to recover 40% of the loan if the borrower, for example, you as a person, if you default. So the recovery rate is 40%. So the bank thinks, okay, if something happens, at least they can recover 40% of that. And then the last one, probability of default, let's assume it's 10%, meaning That's the likelihood that the borrower, in this case potentially you, will default in the next year, and there's a 90% chance that everything will be fine. Yeah, let's do a step-by-step calculation. Let's start with loss given default. So you would start with loss given default equals expected exposure times 1 minus recovery rate, which would mean you start with 100,000 times 1 minus 40% equals 60,000. Yeah, so this is the loss given default. If you really become default, the bank thinks it would lose 60,000 and 40,000 can be recovered. Then let's do the expected loss, which is loss given default times probability, which is in our example loss given default is this figure that we have calculated before, 60k. This is the loss in case of a default times what is the probability of default? 6,000. So the interpretation is the bank expects a probability weighted loss of 6,000 over the next year. Yeah, so expected exposure, total exposure of default risk, recovery rate, percentage of the loan expected to be recovered. Loss given default is the amount lost if default occurs, probability of default, likelihood of the borrower defaulting, and then expected loss, probability weighted expected loss. Yeah. And this sample example can be scaled to larger portfolios. For example, banks and bond investors use this framework to price loans, set interest rates, or determine credit spreads. And the expected loss provides a baseline for how much they should charge to cover the inherent credit risk. Yeah, so that's an example. I will provide some other applications and some other tools and frameworks how to measure credit risk, but this is one of the most used formulas to measure credit risk. Thank you so much for listening. I hope you found this useful. See you in another video. Bye bye.